6 days ago on this channel, we told you Nvidia was reportedly discussing a $600 billion guarantee to help OpenAI pay for data centers and chips. And we said the real test of whether AI spending is a smart bet or a mania was coming within days, when the 4 biggest spenders in the AI economy all reported earnings in the same week. That test happened Wednesday night. Microsoft and Meta reported almost the same story on paper. Record capital spending, aggressive AI investment, strong headline revenue. Wall Street handed them opposite verdicts within hours of each other. Microsoft's stock jumped nearly 9%. Meta's fell as much as 8%, erasing roughly $15 billion of Mark Zuckerberg's personal net worth in a single evening. Same amount of money on the table, by the billions. Completely different judgment. Today on The Current, we open both earnings reports side by side and find the one number that explains why spending on AI made one company richer and the other poorer in the same 24 hours. Quick reminder of the stakes, because this is not just a story about 2 tech companies. If you hold an S&P 500 index fund, a 401k, or almost any broad retirement account, you already own pieces of Microsoft, Meta, Amazon, and Apple, 4 companies now responsible for something close to $725 billion of AI infrastructure spending in 2026 alone. That is not a bet you opt into by following tech news, and it is not one you opt out of by ignoring it. When one of those 4 companies gains 9% in a single trading session and another loses 8%, the difference shows up in retirement accounts that never once mentioned artificial intelligence. This week gave the clearest evidence yet of how the market is starting to sort winners from losers inside AI spending, and the sorting rule turned out to be simpler than most analysts expected. Start with Microsoft, which reported fiscal fourth quarter revenue of $90.01 billion, up 18% and ahead of estimates. The number that mattered most was Azure, Microsoft's cloud computing division, which grew 43% for the quarter, accelerating from 40% the quarter before, and pushed Azure's full-year revenue past $100 billion for the first time in company history. Microsoft spent $35.8 billion on capital expenditures in the quarter, roughly $41 billion including finance leases, and told investors it now expects around $175 billion in capital spending for calendar 2026, lower than the $190 billion many analysts had modeled, aided by an accounting change that stretches data center leases from 15 years to 25. Investors read that combination, accelerating growth alongside contained spending, as proof the AI build-out is converting into revenue. The stock jumped as much as 8.9% in after-hours trading. Buried inside Microsoft's results was a smaller story that connects directly to the circular financing question we raised last week. Microsoft invested $5 billion in Anthropic, the company behind Claude, back in November of last year, and Anthropic agreed to buy $30 billion of Azure cloud services as part of that same deal, a structure that looks a lot like the Nvidia OpenAI arrangement now under scrutiny. This quarter, that Anthropic stake generated a $3.2 billion gain for Microsoft, adding 33 cents to earnings per share, nearly as much in 3 months as Microsoft made on its OpenAI stake for the entire year. OpenAI, meanwhile, was marked down about $600 million this quarter alone, trimming 7 cents off earnings per share, even though the full-year OpenAI position is still up roughly $5 billion. Microsoft is running the same circular investment playbook with 2 different AI labs, and right now, one bet is paying off dramatically better than the other. Now contrast that with Meta, reporting the same evening. Revenue came in at $60.8 billion, up 28%, and ahead of the $59.5 billion analysts expected, a headline that on its own should have been good news. But adjusted earnings per share landed at $6.18 against an estimate of $7.13, a clear miss, as total costs and expenses climbed 55% to just over $42 billion. Operating margin fell from 43% a year ago to 31%, though roughly half of that hit came from one-time items. $2.4 billion in legal charges and $1.18 billion in severance costs, not AI spending itself. The number that actually spooked investors was free cash flow, which collapsed to just $784 million, down more than 90% from $8.55 billion a year earlier, because Meta simultaneously raised the floor of its 2026 capital spending guidance to a range of $130 to $145 billion, up from $125 billion. Meta shares fell as much as 8% in after-hours trading. So why did two companies spending record amounts on AI infrastructure get opposite grades from the same market in the same 24 hours? Follow the cash. Microsoft's spending shows up almost immediately as a line item investors can see and verify. Azure revenue, growing 43%, sold to paying enterprise customers on signed contracts. Meta's spending mostly funds AI features layered into free consumer apps and Reality Labs hardware that does not yet have an equivalent revenue line, so more capex just shows up as lower free cash flow with no matching growth number to point to. Microsoft can say, "We spent more and grew faster," and show you exactly where. Meta can only say, "We spent more, trust that it grows later." After 2 years of AI capital spending increases, that is precisely the sentence Wall Street has stopped being willing to accept on faith alone. The test is not finished. Amazon reports its own quarterly results this evening after this video goes live, and it carries a close cousin of the Microsoft question. AWS, Amazon's cloud division, grew nearly 28% last quarter, a number that would look like unambiguous good news on its own. But Amazon's free cash flow fell to just $1.2 billion over the same trailing period. Squeezed by the same category of spending driving Meta's cash flow down, data centers, chips, and power contracts bought years ahead of the revenue they are meant to generate. Amazon's answer to tonight's test will come down to the same distinction Microsoft and Meta just demonstrated. Does the AWS growth number arrive attached to a cash flow story investors can trust, or does it arrive next to a spending number that keeps outrunning it? Apple reports the same evening, and it faces almost the opposite pressure from the other three. Apple has never joined the trillion-dollar data center arms race the way Microsoft, Meta, and Amazon have, so its capital spending is not the story. The question for Apple is whether its AI features, built into the iPhone and marketed under its own branding, are actually driving people to buy new phones, or whether AI has become a checkbox nobody is paying extra for. This is also expected to be Tim Cook's final earnings call as chief executive before he hands the role to hardware chief John Ternus on September 1st, closing out an earnings era rather than opening one. By the time markets close Friday, all four companies behind roughly $725 billion of 2026 AI spending will have shown their hand. And the story that started all of this, Nvidia's reported $600 billion guarantee covering OpenAI's data center financing and chip purchases, has not disappeared. As of this week, it remains, according to people close to the talks, an early-stage discussion that could still shrink or fall apart entirely. What this week's earnings add is context, not resolution. Microsoft just showed that a circular AI investment structure can generate real bankable gains, $3.2 billion in a single quarter. Meta just showed that raising AI spending without a visible payoff line gets punished immediately, even when revenue itself is growing. Whatever Nvidia and OpenAI ultimately sign will be judged by the exact same test the market just applied to Microsoft and Meta. Not whether the spending exists, but whether it converts into something investors can point to. Zoom out, and this week is the clearest snapshot yet of where the AI economy actually stands, more than a year into the boom. It is not one bubble rising and falling together. It is dozens of individual bets, all wearing the same AI label, being judged one earnings call at a time on whether the spending shows up as revenue or simply disappears as cost. Microsoft passed that test on Wednesday. Meta did not, even with revenue growing 28%. Two more companies take the same test tonight, and the pattern so far suggests the market has gotten considerably better at telling the difference between AI spending that compounds and AI spending that just spends. That is the machine economy, graded in real time, one earnings call after another, with your retirement account watching whether it wants to or not. Subscribe now, because tomorrow on The Stack, we open the file on ASML, the one machine the entire chip industry cannot build a single advanced processor without.